everyone, welcome to Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're tackling a question on every investor's mind. Is the stock market still overvalued? To find out, we'll dive into 4 key indicators that help us measure where we stand today compared to history. Let's quickly break down the methodologies we're using. First, the Cressmont PE ratio. This adjusts for business cycles by analyzing the relationship between earnings and GDP. It ended January at 43.2. Next, we have the PE10 ratio, also known as the Shiller PE. This takes the current market price and divides it by a 10-year inflation-adjusted average of earnings. This currently sits at 38.9. Then we have the Q ratio, also known as Tobin's Q. This compares the total market value to the replacement cost of all company assets. We ended the month at 2.05. And lastly, the S&P 500 Regression Trendline. This measures the index against its historical growth trend using an inflation-adjusted trendline. At 201% above trend, this is our most aggressive indicator, as it highlights just how far today's prices have detached from their long-term exponential growth path. Despite these different approaches, they all share a singular purpose, helping us gauge whether the market is over, under, or fairly valued compared to historical norms. To make these easier to compare, I've adjusted the 3 ratios to their arithmetic means. When we look at the deviation, the answer to the question, is the market overvalued, is a clear yes. But the real question is by how much? As of January 2026, the metrics are the Cressmont PE, 173% above the mean. PE10 ratio, 123% above the mean. The Q ratio, 143% above the mean. And the inflation-adjusted S&P composite, 201% above trend. Putting the market's current overvaluation somewhere in the range of 123 to 201%, depending on the indicator. This is one of the highest overvaluation ranges in history. When we average these 4 together, we get a combined valuation of 160%. To put that in perspective, that's the second highest level in history, trailing only last month's 162%. We're currently more than 3 standard deviations above the historical mean, well into significant outlier territory. Now, some prefer the geometric mean, which is often better for data that grows multiplicatively because it smooths out extreme peaks and valleys. Even with this more conservative smoothing method, the overvaluation range actually shifts higher, between 147 and 203%. The 4 indicator average here sits at 181%, also more than 3 standard deviations above the norm. Now, regardless of which math you use, the conclusion is the same. The market is significantly overvalued, sitting at some of the highest levels ever recorded. A word of caution though, these are not short-term timing tools. Overvaluation or undervaluation can last for years. Instead, use these indicators to set your long-term expectations for future performance. That's all for our January 2026 market valuation update. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.